Program paid for by Right Path Real
Live.
Estate does not necessarily represent the views or opinions of the staff, management, or ownership of this station.
But it should.
It's time to
Hey,
get
can you
on
turn
the
my
right
headphones
path
up just
with
a little
Right
bit?
Path Real Estate
Oh, yeah,
Radio
I can
with
do that.
Tom
What,
Perry.
yeah.
Three.
Get the
Three.
answer to
Okay.
your question that's keeping you from taking
Thank
action
you.
and succeeding today.
Welcome to the show. You got other stuff on your mind,
Man, I
huh?
got a lot going on.
Get ready. The guy that will
favorite way
put
to
your
be.
fears behind
Yeah.
you is on the air now. Taking
Mic's
calls
on.
at
Oh, wait. There we go.
713-785-1817. Toll free 877-881-0271.
Well, there's that.
Now here's your host, Tom Perry.
Hey, good morning. Welcome to the show. Welcome to the show. Right Path Real Estate Radio. My name is Tom Perry, host of the Right Path Real Estate Radio show. I'm joined, as per usual, my good friend, my brother from another mother, my co-host, Mr. Daniel G.
Good morning. Good morning. Happy Monday. I'm fired up today.
It's always great when, so Rob, anyhow. Hey, Rob, thanks for listening to the show. Texting me right here, right now. Perfect timing.
Oops.
Oops.
Happy Monday morning, ladies and gentlemen. Thanks, everybody, for joining us. Love
Yeah.
Your Vibes. Oranica Home Investments on Instagram. Everybody on Facebook. Talking a little bit about some change today.
Yeah. Well, it's the only constant is change, right?
Absolutely.
And which is kind of an oxymoron.
It is.
And but what I can tell you is I've seen so many people. In fact, we talked to somebody Wednesday of last week, guy that said he started acquiring properties 2007. He built a portfolio all the way up to 4,
Yeah.
and then he decided, hey, that's a little too many. Took
Got-
some
got a
equity
little
out.
Too much heat.
Yeah, bought one property for like $27,000.
Yes.
Sold it for, didn't he say like 90 something?
Something like that. Low 90s. I believe.
Yeah, because it needed a lot of work.
Correct.
Needed like 20 or 30,000 worth of work, and he didn't want to put that work into it.
Of course not.
And so, so he sold it for 90, which means that he made 70. You know.
Yeah. In what? A period of 4 years?
Yeah. Right.
Yeah.
And well, actually, more than that. If his 2007 when he was buying, but he's convinced now that.
I thought he said he sold it in 2011 or 2012.
Oh, you're right. He
Yeah.
did. You're right. He did.
Yeah.
Yeah. So and he hasn't been able to find any
Yeah,
deals.
if he would have kept that house until now.
Well, because I asked him, I said, "Hey, what's it worth?" He goes, "Oh, probably not much more than." I'm like, "No, that's not.
Yeah.
It's not.
It was appreciating really well, and then it hit a brick wall.
Yeah, of course. Then it just
No.
stopped. Right. So, so one of the things that I see is that people typically look to the rear view mirror in terms of valuations. And, you know, I know of a particular house. In fact, my parents bought a house in Spring Valley at the corner of Bingle and Merlin. And I can't remember. It's plus or minus $5,000. I mean, I know that there's a $5,000 range.
Yeah.
Right? So if people would give me that, somewhere between $33,000 and $38,000.
Okay.
Somewhere in there was what they bought the house for when I was in 3rd grade.
Okay.
And so, but now, I mean, lot value on that thing's probably north of 500.
Yeah.
With a house on it, probably 700. And, you know, the question is, 20 years from now, will you be able to buy that for $700,000?
No.
No, absolutely not. Right. So appreciation is a for sure thing, and the reason why is because there's as space compresses, right?
Yeah. I mean, at some point here, and it blows my mind that we haven't hit it yet.
Yeah.
Because, I mean, as you know, and most of the listeners know, I have a trek to get to work.
Yeah, right.
I'm way out in Tomball.
Right.
And I know some people are driving into the energy corridor from the Woodlands.
Yep.
And, you know, I've run into people in my neighborhood that are driving to the energy corridor.
Yep.
And very rarely are they driving past south of downtown.
Right, right.
That typically doesn't happen unless it was an accident.
Correct.
But at some point, to me, there is a zero-sum game where there's a barrier line. We can't see it, but at some point, people are not willing to drive that far to get to work.
Correct.
Right?
Yep.
Now, I know some business professionals have to take the Von Lane bus to Dallas back and forth every day.
Right.
Typically a temporary situation.
Right.
But if we're talking about building the house that you and your family are going to live in.
Right.
And if they're taking a commute long distance like that,
Yep.
it's because they don't want to move their family.
Right.
Right. They're in
Right.
the school. They're trying to get a kid graduated.
Right, yeah.
Something like that.
Right.
But for me, it's like, is it Hockley? Is
Yeah.
it Waller?
Right.
Where does that barrier happen? At some point, we will hit that barrier where it no longer makes sense for people to commute into the city.
Yeah, what I think the people buying out in Hockley and places like that, they're not commuting to downtown. I think that they're, because there's big manufacturing facilities that are being built out in Hockley. And
Well, and I'm talking a lot about these $500,000, $600,000, $700,000 neighborhoods
Oh,
that
yeah.
are popping up out
Yeah.
in Tomball and Waller
Right.
and different places like this. I mean, those people aren't working out at a manufacturing facility unless they're running the place. But then again,
they could be that they're all, but they're dentists. They're I mean, because the community grows. They're,
Yeah.
they're dentists. They're doctors. They're attorneys. I mean, they're all the trade professionals.
but
And they're,
at the end of the day, without Houston being here, that wouldn't be there.
correct.
So where does that stop? It's got to stop before we get to Dallas. Otherwise, they're going to start going to Dallas. It's got to stop before we get to San Antonio. Otherwise, they're going to start going to San Antonio. But it blows my mind how far out we've gone now, and that people are willing to commute that far.
The answer I think is that when people quit coming to Texas,
Yeah.
because look at how Madisonville's blowing up. I mean,
Oh, yeah. I mean,
who'd have thought that?
you don't think it's because of the Buc-ee's, though?
well, I think that doesn't hurt.
It doesn't hurt.
But there's a reason why Bucky's went there, right?
Absolutely, yes.
So, when you look at Madisonville, you look at, I mean, there's growth in a lot of areas, and I think it's because Texas is a very business friendly state, except for one city. There's one city in Texas. I think it's a large city that's not very business friendly.
Little California.
Yeah,
call it that.
yeah, we'll call it the mini California.
Mini California.
MINI, not
There you go.
MANY. Yeah,
There you go.
The mini California. So, but yeah, I mean, I think that chemical plants are strong. I mean, I don't know what the long-term repercussions are going to be with West Texas crude, as opposed to all the Permian Basin oil and gas and things like that. But what I'd say is long-term, I do believe that real estate in the Houston market is going to be really, really strong. In fact, you and I, we were talking last night on the phone and looking at a particular area. I mean, it's, along the Grand Parkway. I mean, I know that really narrows it down. 'Cause, a couple of...
right there on the Grand Parkway.
Yeah,
right there.
right there. I mean, it was just either north or south. I don't really...
Yeah, it was just north.
Yeah.
Yeah.
No,
Oh, gotcha.
it's either just north or south
north
of the...
or just
Because
south of the Grand Parkway.
isn't everywhere just pretty much north or south of the Grand Parkway?
Yes.
It's one of the... Or else it's on the Grand Parkway,
Yeah.
right? Which they don't do much building on the Grand Parkway. So and the question, because I remember when the Beltway was put in,
Yeah.
and especially on the west side of town, and that was really out in the boondocks. And now you look at that and there's jobs going out there, and there's house. I mean, it's like it's all they're building communities there, right?
Yeah.
And having a major stretch of road like that, there's a reason why the highway department puts...
Yeah, there was some civil engineering going on long before they broke ground on building that road, right?
Absolutely right.
The city planners and the civil engineers, they know what's going on, they know the trends, they know what needs to be done.
Correct.
At least you hope so.
Yeah.
And they didn't put that kind of money into that big of a project without expecting the growth.
Yeah, and so when we look at how does a family build wealth and income for the long term, and what it really comes down to is when you start calculating your rate of return on your investment, then there's two factors to take into consideration. One is how much time do I have involved, and then how much of my money do I have involved. And so I've not seen anything better than single family real estate. And I've looked at multifamily, I've looked at commercial, I've looked at industrial warehouses, I've looked at retail strip shopping centers, I've looked at multifamily. I mean, all of the different real estate things, and then I've looked, compared that with, day trading and Bitcoin and all these things, and so, it's what. And there's the factors that I take into consideration is one is how much legislative changes are going to be, and the only risk factor that I really see, long term is are the governments ever going to start taxing landlords differently than they tax other property owners, things like that, which they already do from the standpoint of property taxes, in that you can get a homestead exemption for your homestead, but you don't get homestead exemption, so you already pay a little bit of a premium because it's not a primary owner occupied property at that point. But outside of that, I mean, when I obviously learned a lesson, for those of y'all that know my story, learned a very valuable lesson when I used to own a wholesale health insurance agency. I had 110 agents in 7 states, and we were growing pretty aggressively. I mean, 10 agents a week in a state a month. And one of the things that I discovered through that experience is that legislation can be passed in situations like that where you're basically out of business. I mean, I was out of business in 30 days because there were major carriers, people that were risking hundreds of millions, even billions of dollars, and said, hey, we don't want to take the kind of losses that we see coming and not even take the risk, right? There, people with that kind of resources are very risk averse. They're trying
especially when it was uncertain as it was, right?
Correct,
like,
absolutely.
Hey, we're going to read it later. Well,
yeah.
put the brakes on.
Well, they started asking some really good questions, and the people that had written the legislation couldn't answer it.
Yeah.
And then with, anytime you have to deal with things retroactively, that you're on the hook for decisions that are made in the future, but it's a retroactive kind of thing. That's a bad situation. So when I look at what's the legislative risk for that situation, like I think there's a much bigger Airbnb legislative risk.
I would agree with that 100%.
Than there is on single family houses for
and you're
buying
seeing
home.
it in some states already.
Yeah, absolutely. And now, is that going to necessarily happen in Texas? I really don't know.
Yeah.
And so my crystal ball's still in the shop. It's very frustrating. I've called customer service hotline. The line's always busy.
Yeah, and the
are on
whole
hold.
time.
Oh my God,
so
it's
long.
crazy. So, but when I look at what's the legislative risk, when it comes to single family buy and hold, and I don't really see any greater than any other type of business.
Yeah.
I think that's pretty well equal. So the music says we're out of time.
Let's continue that conversation on the other side of the break.
Yeah, we'll be right back.
Hey, good morning, Andy. Hope you're traveling well. Good morning, Ben. Good morning, JoJo. Good morning, Tammy.
Hello, real estate investors. Do you need a lender that moves fast at the speed of a jet to fund your investment properties? Jet Lending will help you purchase properties quickly with as little cash out of pocket as possible. Jet Lending also sets up a repair escrow fund to help you with repair costs. Jet Lending has originated over 2,000 loans in Texas.
You know what he's telling me?
valued at
No.
over
The price he paid
$250
for that
million.
house.
Jet Lending will help you evaluate your deals for free.
You just
and
threw
give
back
you
a number at him.
feedback
Just
on
because
value,
1,400.
cost of repairs, and potential loan amount. Jet Lending is your fast and friendly
That's
hard
hilarious.
money source for first-time investors and seasoned professionals. Call 281-872-7800 or email us at info@jetlending.com. Oh, and don't forget about our famous Third Wednesday Super Investor Networking Meeting. Lots of fun, lots of great real estate talk. We'll see you there.
Time is money in a real estate deal. If your insurance company is slow or non-responsive, you could lose a deal like that. You need a quick turnaround on quotes, binders, and the agency for that is Benchmark Insurance Group of Texas. The team at Benchmark understands the investor mindset. They know what you need and when you need it. It's there for you. Call Houston's leading real estate risk management experts. Benchmark Insurance Group of Texas. 281-569-4353. That's 281-569-4353. Or online at benchmarkbroker.com.
Are you looking for an
1
investor-friendly
minute.
general
So this is some
contractor
kind of
for your
machine.
investment property? Then
So
call
the house that I
Fast Track
grew up
Remodeling
in
at
and from
832-742-9992.
Your brother told me that was
or
for
reach us
sale.
on the
Is on
web
MLS,
at
yeah.
fasttrackremodeling.com.
Fast Track Remodeling specializes in turnkey remodeling of single-family investment properties. Whether it's a flip
And what's
rehab
funny
or a
is
rental
all
rehab,
the
we manage every
remodeling
aspect
that
of
my-
a rehab
that
from
your
parents
start to
did
finish
still there,
with
yeah.
a highly efficient,
That's awesome.
standardized process.
Over the last 6 years, Fast
picked
Track
out
has
some real
completed over
high-end,
700 projects, which has helped us to create our 3 keys to success. Use a detailed scope of work so that everything gets done. Train and maintain quality crews so
And
it
it's
gets
not
done
selling,
right. And
'cause
complete the work in a proper
it
order so
obviously
it gets done
needs-
fast.
It needs work.
No more managing it yourself. No more doing the work yourself. Fast Track Remodeling really does
Yeah,
manage
it's
it all.
technically a flip
So
product,
give us a
but they're
call
selling
today
it like it's
at
not.
10 seconds.
832-742-9992. Again, that's
Like, they didn't have that
832-742-9992. Or reach us on the
but
web at fasttrackremodeling.com.
My parents put that floor in.
This is Business 1110.
Mike's on.
Hey, welcome back. Welcome back. Right Path Real Estate Radio. So, yeah, just going through the pictures of the house that I grew up in.
713-785-1817. We are a call-in show. Put your fear behind you. If you got any questions, if you're stuck, we'd love to.
Yeah, so that
Help you
mirror
out.
was there when I was a kid,
Really?
and then they used to have a treadmill. And,
Okay.
and I would and there was a pool out here that somebody's removed, and used to run, on the treadmill.
And then go jump in the pool?
Yeah, right.
Nice.
Of course. And then isn't that lovely? That didn't look 1980s at all, does it?
No.
It's kind of sort of.
That's awesome.
Yeah.
Look at the counters.
Yeah,
Even.
I know, right? Yeah. That was really nice. That's onyx on top of the gold turn knobs.
Nice.
Isn't that great? So anyhow,
So we were talking about legislation.
yeah,
And for me, it's, you've got however many hundreds of people in the legislative body.
Yep.
And you can almost guarantee that some of them, 2, 3, is it 5, have an insurance background. To where that maybe they at some point they spent some time in that industry, or maybe they have an agency somewhere, they stepped away from that to become a congressman or start to get into politics or whatever. That may be the case.
Yeah.
That's not enough influence to affect legislation.
correct.
You can also pretty much guarantee that every one of these guys owns property.
Right.
So for me, the legislation risk is a lot less in a situation where
Yeah, almost, I
they
think
would
all
have
of
to
them
be shooting themselves in the own foot.
Everyone except for AOC and a couple of those
Yeah,
other
exactly.
younger one, they don't actually.
Yeah,
own
they're just
property.
renting.
Yeah,
They're-
right.
They have an apartment.
Right. So then they're all for rent control.
Yeah,
and
of
stuff like that,
course.
right. Sure. Anyhow, so okay, yeah. So go ahead.
So I think it's smart to, if any industry you're going to get into.
Yeah.
Hey, what is the legislative risk?
Right.
And while the returns in real estate are what we find better than anything else we can find,
Right.
we also feel that the risk in most situations is lower as well.
Right.
And the legislative risk, I think, is definitely lower than a lot of these other
Sure.
other industries.
Right. Well, and then you also have to look at competition and what's like, is there technology that's going to change, the business? Like I was also previously in the photography business, and I used to buy, on a weekly basis, about 15 to 20 100-foot rolls of 70 millimeter film.
Oh, wow.
From Kodak,
Yeah.
and which is, it's, and we were shooting probably 15 rolls a week
Okay.
of 100-foot long.
Wow,
So
that's a lot of- that's a lot of film.
1,500 feet of film.
Yeah.
And you could get about 680 to 700 shots on 100 feet of film,
Okay.
depending on how much you. Anyhow, long story.
We'll get into that.
Yeah, but when things went from film to digital, there was a transition period. If you remember, first digital cameras were, over $10,000.
Yeah.
In fact, we had a video proofing system. One of the very first times that you didn't have to get proofs sent back to you, because you remember, like school pictures, things like that.
Yeah.
They send you a whole package, but then you
Yeah.
get to order extras from
Based
that,
on-
right?
Yep.
But you actually got to see the prints first, and that's the way photography was done for years and years.
Yeah.
And then,
even the school pictures now, it's all
Yeah.
online.
Right.
You can go, you can see the picture.
Right.
They're never printing anything until
Correct.
you order it.
right,
You
everything's
order
digital,
it right there. Yeah.
right. But we had a video proofing system that was so expensive. Kodak came out with it called a Prism system.
Okay.
And they would only lease it to you.
Oh,
And
wow.
Just the lease payment for each. We were running 3 camera rigs at the time, and each one that we had was almost $800 a month.
Oh, wow.
Just the lease payment on a 3-year lease, and at the end, I think you could buy it for $1 or but you do the math on that. It's
Yeah.
about a $30,000 rig.
Yeah.
So, that's a lot of money to spend on
Yeah,
camera,
absolutely.
just the equipment.
Just the equipment.
So anyhow, so when there's technology involved or there's legislative risk, those are 2 risks that a lot of people don't consider on businesses that
Yeah.
they get involved in. So, but when you're talking about buy and hold single family real estate, there's a reason why people park their money in real estate for the long play.
Yes.
And what I'd say is that commercial real estate does appreciate over time. However, it takes longer when you're overpaying for that real estate. Now,
Yes.
looking at where a lot of people get lost in this whole equation is that I can't look at where single family real estate was, back in 2008 when you could buy. I saw a lot of people that were buying houses for $65,000 or $70,000.
Yeah.
And putting $30,000 in it, and the houses were appraising for $120,000.
Yeah.
So they were getting some captured equity.
Absolutely.
And they were also because out of pocket, they could be as little as $5,000 out of pocket on a deal. So if you had $100,000, you could buy 20 single family houses because you're only. But now that those rules have changed, and here's the reason why. The properties have appreciated, but there's fewer. There's almost zero foreclosures, and I would say there's almost zero retail activity. In other words, the people that want to buy the house at retail, it's almost in the price range. $130,000 to $170,000 and below.
Yeah.
I believe that 8 or 9 out of every 10 of those transactions are investors buying those
I would
properties.
agree with that. And let's talk a little bit about why that is.
Yeah.
What makes the $130,000 to $150,000 house? Why is that becoming such a rare thing for a retail buyer?
Yeah, so I think several reasons. There are 3 primary reasons. One is that when you look at after the passage of Dodd-Frank, pre Dodd-Frank, the joke was you could fog a mirror and get a loan.
Yes.
And then they actually put in real underwriting where they looked at your credit and your job history and your income and your debt to income ratio and all the things that good underwriting should do. And when mortgages, what they call mortgage-backed securities, when those went south, then essentially what happened is I think investors started looking at, do we want to invest our money when we're buying those financial instruments that are backed by mortgages? When you stop and think about, the median home price in Houston is about $240,000. So if you make a loan on a $300,000 house, that's a household income typically of $150,000 plus. Yeah. So you've got oftentimes professionals or people with college degrees, you've got a family, all of those kind of dynamics. When you start moving down into the, $120,000, $130,000, $140,000 price range, as an investor, I say, who is that underlying buyer? Who it's a first-time home buyer. It's somebody that's not very financially savvy. It's somebody that is at the lower end of the spectrum in terms of
and
of
they're probably
income.
making $40,000-$45,000 a year, right?
Yeah, it's somebody that's right. It's a less stable job. It's a less stable household. There's a lot of variables that makes that person a much higher risk on defaulting on the loan.
Yeah.
That's somebody that lives closer to the bone. They don't typically. It takes all of their income really to meet their basic monthly needs, right?
Yeah. And it's a paycheck to paycheck thing.
It is.
And one missed paycheck causes that whole thing to go downhill.
And I'm not saying the people that as a family make $150,000 don't oftentimes also live paycheck to paycheck, but there's a bigger margin there.
Like you said, I know some people that make over $1 million a year that live paycheck to paycheck.
Of course, right.
But in the event of an emergency, that person has the access and the savviness to get what they need to take care of the situation.
Correct.
As to where the $130,000 home buyer probably doesn't.
Correct.
Right. And I was actually a little bit off subject, but I was reading an article this morning that McDonald's and a couple of these other big corporations are creating some tools to allow their employees to take their pay on a daily basis.
Yeah, because they're that tight.
Yeah, and it's like, hey, does that help or hurt?
Yeah.
Like, it just seems super dangerous to me. But giving somebody access to that money, typically the paycheck to paycheck part is what keeps them in line, right?
Yeah, right.
Hand them the money on a daily basis is going to cause even more problems, I think, in the long run. But as a lender, you can only make a certain amount of money on a loan.
Correct.
Right?
Right.
And I would argue that it takes even more work and more underwriting to qualify a person for a $130,000 loan.
Well, that was the second thing that I wanted to bring up is that the fee structure, because of Dodd-Frank, they used to, because let's face it, title, real estate agents, all of those, everybody gets paid a commission of the size of the deal. So you find, savvy real estate agents, they may start at, at the lower end of the spectrum because there's more houses that, in $200,000, $210,000, $220,000. That's a very in-demand price versus, $5 million houses. But let's face it, they're going to make more net dollars, maybe a lower percentage, but more net dollars on a $5 million house than they would on a $200,000 house, right?
Of course.
So, if everybody knows that agents make historically 3%. Not that there's no collusion or anything like that, but that's just the acceptable. And it's all negotiable.
The market standard, all negotiable.
The market standard is 3%. So if you're making 3% of $120,000 house, it's $3,600. If
Yeah.
you're making 3% of a $300,000 house, it's $9,000. And I would argue it's the exact same path, the exact same. You still need a survey, you still need inspections, you still need the negotiation. I mean, it's like all the things. Whether you're on the buy side or the sell side, you're doing the exact same amount of work. So would you rather make $3,600 or would you rather make $9,000? And so there's not many people going at that lower end of the spectrum from the mortgage brokerage side, from the agent side, from the title insurance, because it's as much title work to do a $120,000 title policy as it is to do a $400,000
Absolutely.
property.
Very often it's more because of
Correct.
the
Issues on title and
issues
things
on
like
title,
that.
right.
Correct. And so there's not really anybody that's actively servicing that marketplace. So I think it's harder right now. And those people are having a tougher time qualifying for the mortgage. So I don't think that they're actually, the retail buyers are going after the properties in the $130,000, $140,000 price range. I mean, it's almost always first-time home buyers that are going after that price range.
Yeah.
And many times they're going after newer houses. They're moving out further. They're moving to the Hockleys and that kind of stuff.
Absolutely.
And they're because they want a new house. And so as a result, I mean, what's happening is that investors are able to step in and buy properties that are below replacement cost, which as long as the cost of building a new house is going to continue to rise, then that house is going to, like we were looking at a house yesterday, built in 2009, I think it was?
2005.
Okay. Yeah. So, it's 14 years old.
Yeah.
And that's in the grand scheme of things, that's a relatively new house. I mean, it's not brand spanking new. I mean, there's a couple of things that you have to. I mean, I'd look at the air conditioning. That's probably. Foundation should be good. Roof should be good. I mean, you should be only halfway through the life of the roof.
Yeah.
The condenser might be getting towards end of life. Depends on on several different factors and things like that. But it probably needs new. If there's carpet involved and if it's original carpet, that's probably
get that
needs,
changed out. For
correct,
sure.
Absolutely. But outside of that, structurally it should be really, really good.
Yeah.
Using relatively modern building technology, you're not going to have asbestos, not going to have lead-based paint, not going to have those kind of things. You're going to have a lot of the more common. You're not going to have galvanized, supply line plumbing. So all of those things should be really, really good for you. And you're able to buy that for cheaper than what they can build new right now. By the time you count the land and the development expense and all of those kind of things, I mean you're rock solid. I mean that's fantastic. So and the question is going to become is 5 years from now, do you think that labor for building a new house and materials for building a new house are going to be higher or lower than today?
So my answer is no, it's not possible. But I get that from sometimes I'll ask somebody that question and they'll say, well, I mean, it's possible. Or just like, you were having a conversation with the guy the other night and it's like, hey, are you waiting on another $80,000 house?
Yeah.
Music says we're out of time, guys. We're going to take a short break, but we'll continue this conversation. Please stick around. Hey, good morning, Brad. Good morning, Johel. Good morning, Joby and Commander Rude on the gram.
Hello, real estate investors. Do you need a lender that moves fast at the speed of a jet to fund your investment properties? Jet Lending will help you purchase properties quickly with as little cash out of pocket as possible. Jet Lending also sets up a repair escrow fund.
This was the master
to help you with
closet
repair
when
costs.
the house was
Jet Lending
first.
has originated over 2,000
Done.
loans in Texas, valued at over $250 million.
They added, this is about 5 feet from here to there, so they added that 5 feet of
repairs
house.
and potential loan.
Oh, okay.
Jet
Yeah.
Lending is your
It was
fast
originally
and
a
friendly
5-bedroom,
hard money source for first-time investors and seasoned professionals.
2.5 bath house,
Call
and they changed it into a
872-7800
5-bedroom,
or email us at
2-bath.
info@jetlending.com.
And changed it into a
and
4-bedroom,
don't forget about our
2.5,
famous Third Wednesday
where
Super Investor Networking Meeting. Lots of fun,
This is the
lots of
upstairs
great real
bath.
estate talk. We'll see you there.
So this was a 5th bedroom, but they changed it into a closet and stole some of the space.
Hell of a closet.
Yeah.
Time is money in a real estate
Yeah, there used
deal.
to be a pool right
If
here.
your insurance company is slow or non-responsive,
And
you could lose a deal
Behind
like
this,
that.
there was a fountain.
You need a quick
right in that
turnaround on
corner.
quotes or binders. The agency for that is Benchmark Insurance Group of Texas. The team at Benchmark
And this is the one where they
understands the
filmed,
investor mindset.
No.
They know what
It's
you
not.
need and when
No.
you need it. We're here for you.
No.
Are you a rehabber, wholesaler, buy and hold, or flipper? Bundling your property
this
on
was-
a single policy will help save time and money. Benchmark has been in business for over
2
10
houses
years,
before that.
and we insure over 30,000 properties. Contact Benchmark about our exclusive investor package. Call us and let us show you what we can do for you at 281-569-4353. That's 281-569-4353.
Hey, Chris, thanks for sharing.
Or online at benchmarkbroker.com.
You know what's interesting is
That's benchmark.
this is a property that's priced.
That's 281-569-4353. Or
Classic,
online
you know,
at
family mistake,
benchmarkbroker.com.
right? It's too
Are you
expensive
looking
for
an
tear down for
investor-friendly
lot
general
value,
contractor for your
and it's
investment
also
property?
too much
Then
money
call Fast Track Remodeling
for
at
the full rehab that it needs.
832-742-9992
Probably needs 100 grand in a rehab,
or reach
right?
us on the web at
I think it's about 2,600 square
fasttrackremodeling.com.
feet.
Fast Track Remodeling specializes in turnkey remodeling of single-family investment properties. Whether it's a flip rehab or a rental rehab, we manage every aspect of a rehab from start to finish with a highly efficient, standardized process.
My dad
Over
said
the
he bought
last 6
that house for
years,
42.
Fast Track has completed over
Oh,
700
wow.
projects, which has helped us to
That's
create
crazy.
our 3
Yeah.
keys to success. Use a detailed scope of work so that everything gets
What do
done.
they have it listed for
Train
now?
and maintain quality crews so it gets done right, and complete the work in a proper order
Cost
so it gets
700.
done fast.
No more managing it yourself, no more doing the work yourself. Fast Track Remodeling really does manage it all.
10
So give us a call
seconds.
today at 832-742-9992. Again, that's 832-742-9992, or reach us on the web at fasttrackremodeling.com.
This is Business 1110. Mic's on.
Hey, welcome back. Welcome back. Right Path Real Estate Radio. So, what were you talking about before the break?
We were talking about change in real estate.
Oh,
And we
yeah.
were talking about the conversation we had. You know, the guy says, you know, people just aren't selling their $90,000 houses anymore. It's like they don't want to let them go.
No, right.
It's like, hey,
No, they're hanging on to them.
that is not.
Yeah, they're not. Well, they're not on MLS,
Yeah,
so
'cause
they must be hanging on to
They're
them.
just not selling them.
Yeah, and I'm like, no, those $80,000 houses are now $120,000
Yeah.
houses.
It's like,
And
and you're hardly seeing those anymore, right?
Well,
because they're all 150.
One of the examples that we give in our weekend event is that you know, there was a house that we bought that for $65,000, and it needed I think we put 13 and some change into the
Yeah.
rehab, and so we're all in for like 78,000, and you know, after spending 78, we sold it for like 119.9.
Yeah.
Which was full blown retail. I mean, we
Yeah.
did a nice rehab. I mean,
Killed it.
Yeah, I mean, it did really, really well on the whole thing. And but the frustrating thing is, just a year later, houses in that whole neighborhood were selling for 140.
Yeah.
And then another year later, 160. And then another year later, 180. So if you did your search to see how many houses, you know, were for sale for 120 in that neighborhood, it would come up to next to nothing. And you
Yeah.
go, well, all the people with those $120,000
I
houses,
mean, they're comfortable. They like the neighborhood. They're not going anywhere.
They're hanging on to them.
Yeah.
And they're like, no. Those are now $180,000 houses. And the rents had risen also. That's the thing, is that the rents had gone from $1,200 to $1,400 to $1,600 to like $1,700 and some change. So, you know, it was a $180,000 house and $1,700 a month in rents, which, I mean, it's a really good, and that's what you call wealth building. I mean, imagine if you bought 10 houses like that, and in just 3 years' time, that's your net worth growing by $600,000.
Yeah, off of 3 properties.
Off of 10.
Oh,
Off of 10 properties.
In 3 years.
In 3 years. Now that's not counting the cash flow that you're getting. That's not counting the equity capture. I mean, like in our situation, I mean, imagine if we'd have been all in for 10 houses at 65 plus 13,000, and
Yeah.
so you
Let's call it 80.
Let's call it, okay, so that's $800,000, and then those 10 houses would be worth $1.8 million just 3 years later.
That's $100,000.
That's
$333,000 a year.
Yeah.
You could live off of that.
Yeah, which is $1 million in 3 years on an 8. So you're turning $800,000 into $1.8 million in value on houses, right? So, and you get the difference between the, you know, what you owe. Like, imagine we would have borrowed all that money, so
Yeah.
we'd have $800,000 in debt, and and originally we would have had, $1.2 million in total value. So we'd have had $400,000 of captured equity immediately.
Yeah.
But then add another $600,000 on top of that. So, making $400 immediately is not bad. So that's the real thing that we're talking about, is that even if you don't have the captured equity on that captured equity side. Now, something else has just come up. We've given this example, and we want people to tune in tomorrow night to the webinar we're going to do. We're going to do a live webinar tomorrow night, right? Oh, it's a recorded webinar.
It's going to be recorded because Andy is traveling the globe.
Yeah, right. When did he come back?
I think he gets back Sunday.
Okay, got it.
Yeah.
All right, cool. All right, so Andy will be gone, so it'll be a recorded webinar on Tuesday, but it's going to be absolutely fantastic. And one of the things that we look at is, if you bought a $150,000 house and you put 20% down and you leverage the other 80%, now you're leveraged 5 to 1. Now, let's say that you bought a house just off of MLS. Because of closing costs, and you're gonna have closing costs in two areas. One is on the lending side, because the lender makes there's some fees, there's some, there's origination fees, there's the process. I mean the document fees, all that kind of stuff, right? It's about $1,500 to $2,000 on a typical loan. Sometimes more, sometimes less, depending on the product. And sometimes you're doing hard money, and then you're doing refinance out, so you've actually got two
sets of closing costs.
Two sets of closing costs, and then two sets of. So now there are lenders out there that will do one closing for investors and those kind of things. So you got to look at those. But sometimes, on a $150,000 house, you might be as much as 5% over
negative equity.
Correct. So you actually have negative equity. However, when it's growing at 7% per year, it's provided that you're not in a situation where you're planning on selling in a year's time.
Yeah.
Because then you're going to get killed by your selling cost as well, right? Because you're going to have about a 10% selling cost. But if your strategy is to build wealth, these houses that we're talking about, and again, I'm not saying that every house appreciates at $20,000 per year.
Correct.
But if you're appreciating at just 7% on a $150,000 house, which I think is conservative in a lot of markets. That's $10,500 of wealth, and it's over a 5-year period of time.
Yeah.
That's $52,500 over 5 years per house.
Yeah.
Per house.
And it's breaking down for a lot of folks, because more and more I'm coming across somebody's like, hey, I'm going to pass up on that deal because there's not enough equity in it.
Yeah, right.
And it's like, hey, your equity is coming.
Yeah, right, yeah.
You're going to pass up on $50,000, $60,000, $75,000 in equity over the next 5 years.
Correct.
Because you're negative $2,000 in equity today.
Yeah.
Think about that. Are you trying to build today, or are you trying to build a future?
Well,
if you're trying to build a future, let's talk about the future numbers.
Yeah, so it was incredible that we were in a deal for $73.5 that was worth $120, right? But imagine if we had what if we'd have been in for $125 or even $130?
Yeah.
And it grew to $180.
In 3 years.
What would in 3 years' time?
And here's what I can tell you: the people that get on this train and realize that now, are going to people that are take advantage of this market, and eventually, that's going to be your only choice.
Correct.
You can take the time and find a home run equity deal once every 3 months, once every 6 months, whatever that is. But if you're trying to do this as fast as possible to build your wealth,
yes,
not every deal is going to be a home run. You've got to make some base hits.
Correct.
And a lot of these deals are great, singles, doubles, even triples.
Yeah, right.
And people are not taking them because they're not home runs.
Right.
And it's like, hey, you're going to miss the train.
Right.
And in 10 years, you're going to be like, oh, if I would have just bought that house.
Yes. Now, in baseball, doubles and home runs are fantastic. The Astros did incredible. I don't know if you watched the game last night or yesterday.
Listened to most of it.
Yeah, but the Astros, locked up the division. We won the West, and but you know what? Singles consistency of getting on base. You don't. What you don't want is you don't want to get out, right?
Yeah.
So here's the question: is when you look at risk versus reward. Obviously we always want to maximize our reward, but what risk are we taking? So we're looking at a property right now that I think you can get in for 135, right?
Yeah.
And after closing costs and things like that, you're probably going to be in it for about 141, 142, and it's probably going to appraise for about 135, 136. Now, you're going to have equity immediately because you're going to put down 20%, right?
Yeah.
Now, you're 20% down plus, maybe you are about 5% over what it appraises at when you're talking about borrowed money plus closing costs and all that. So closing costs, you're going to be in it for a little bit more. However, can you lose money on that deal? It's going to cash flow month one.
Yeah.
You will make about 12, or actually I think the number's on it, about 15% cash on cash, right?
Yeah, close to it. 15%.
Okay, so 15% cash on cash. That means, now most people would be thrilled with that by itself.
Yeah.
But when you take that and you combine it with the appreciation, then you combine that with the depreciation that makes your cash flow tax reduced,
Yes.
right? I mean, I get fired up and excited about what the kind of wealth building is that you can do in a relatively short period of time. There's no reason why people can't generate, a couple of $100,000, $500,000. When I look at what that's happening versus when you're at the absolute top of the market in the stock market right now, and what's going to happen with pension funds and the stock market as baby boomers start pulling their money out of the market for health reasons, for wealth and not just them. It's that as baby boomers are getting older and if they pass away, oftentimes the family, in order to split up the proceeds, they don't leave it in that, so it creates a tax event. But they, like a lot of people, that when they're inheriting net wealth, they want to liquidate it. They want it. They want it cash now. They want to go on vacation. They want to pay off debts. They want to pay off all those kind of things. So, in order to liquidate, you got to sell all those stocks, right?
Correct.
And so what happens, because the market's all about supply and demand, right? As the selling pressure exceeds buying pressure, right? When there's more sellers than buyers, prices go down. So what happens when that's happening on a large scale? And the question is, do you want to be in the marketplace when that starts happening? Or would you rather be in real estate where people are moving to Texas? I mean, just Google Texaplex.
Yeah.
And look at how many people are coming into the area of Houston, Dallas, Austin, San Antonio, that triangle, 45 going north and south, to Dallas, and then 35 going, north and south and west to San Antonio, and then go
2
I-10.
minutes.
I mean, San Antonio is growing, and Austin is growing, and Dallas is, North Dallas is just...
Oh, it's blowing up.
It is. I mean, it's incredible what's going on in Prosper and McKinney and all of that area. And then Houston. I mean, name me an area of Houston that's not growing. I mean, it's growing west, it's growing east, it's growing north.
Yeah.
I mean, it's growing. I mean,
It's
it's not growing southeast because you run into the water.
Yeah,
So,
and I was making a joke the other day. I don't remember who it was, but I was like, "Hey, the next loop, they're going to have to build a bridge, right?"
Yeah, right. Yeah,
because it's not going to that circle's not going to cover it.
yeah, it's not right. Yeah, so you're listening to Right Path Real Estate Radio. If you want to give us a call, 713-785-1817. So when I look at where does, people ask me a lot, well, Tom, what percentage of your money is in real estate? Versus, I'm like, as opposed to what?
Yeah.
And I'm like,
The checking account?
yeah, I mean,
One minute.
why would I have it? Yeah, I mean, I've got liquid cash, for liquidity, and that's the only downside I really see with real estate is the liquidity. That if you wanted to sell a property, I mean, it might take 6 months, so you can't have 100%, where you don't want to have $1 in your checking account, right?
Yeah. Well, and you can also argue too that if you need to sell it quickly with the right price, you can sell it.
Yeah. Of course.
almost immediately.
Correct. Right. Yeah, with the right price. I mean, yeah, of course. You could invite sales with the right price. That's for sure. You're listening to Right Path Real Estate Radio. The music says we're out of time. We will be back in about 2 or 3 minutes. Stay tuned.
Hey, good morning, Diego. Good morning, Bob. Good morning, Perla. Good morning, Charlie. Good morning, Robert. Good morning, Ashley.
Yeah, what he said.
I second that.
Time is money in a real estate deal. If your insurance company is slow or non-responsive, you could lose a deal like that. You need a quick turnaround on quotes or binders? The agency for that is
I'll be right
Benchmark
back.
Insurance Group of Texas. The team at Benchmark understands the investor mindset. They know what you need and when you need it. We're here for you. Are you a rehabber, wholesaler, buy and hold, or flipper? Bundling your properties on a single policy will help save time and money. Benchmark has been in business for over 10 years, and we insure over 30,000 properties. Contact Benchmark about our exclusive investor package. Call us and let us show you what we can do for you at 281-569-4353. That's 281-569-4353. Or online at benchmarkbroker.com. That's benchmarkbroker.com. That's 281-569-4353. Or online at benchmarkbroker.com.
Hello, real estate investors. Do you need a lender that moves fast at the speed of a jet to fund your investment properties? Jet Lending will help you purchase properties quickly with as little cash out of pocket as possible. Jet Lending also sets up a repair escrow fund to help you with repair costs. Jet Lending has originated over 2,000 loans in Texas, valued at over $250 million. Jet Lending will help you evaluate your deals for free and give you feedback on value, cost of repairs, and potential loan amount. Jet Lending is your fast and friendly hard money source for first-time investors and seasoned professionals. Call 281-872-7800 or email us at info@jetlending.com. Oh, and don't forget about our famous Third Wednesday Super Investor Networking Meeting. Lots of fun, lots of great real estate talk. We'll see you there.
Are you looking for an investor-friendly general
1 minute.
contractor for your
Yeah.
investment property? Then call Fast Track Remodeling at 832-742-9992
That's
or reach us on the web at fasttrackremodeling.com.
Fast Track Remodeling specializes in turnkey remodeling of single-family investment properties. Whether it's a flip rehab or a rental rehab, we manage every
So
aspect
this
of a rehab
was
from start to finish with a highly
Saturday,
efficient,
getting ready to
standardized process.
Go.
Over the last 6 years, Fast Track has completed over
That was her
700
date.
projects, which has helped us to create our 3 keys to success. Use a detailed scope of work so that
they-
everything gets done.
pictures with the
Train and
moms.
maintain
Yeah,
quality
homecoming.
crews so
Yeah,
it gets done
uh-huh.
right, and complete the work in a proper
but
order
then they-
so it gets done fast.
Once pictures were
No
done,
more
then
managing it yourself. No
heading
more
off for the
doing the
date,
work
so-
yourself.
Nice.
Dad
Fast
was the
Track
Uber
Remodeling
driver.
Really does manage it all.
So give us a call today at 832-742-9992. Again, that's 832-742-9992, or reach us on the web at fasttrackremodeling.com.
This is Business 1110. Mike's on.
Hey, welcome back. Welcome back. Not going to give out the phone number because there's no time to call, but we need to talk about our webinar tomorrow. If you want to find out what the numbers look like, if you've got $100,000, $300,000, $500,000 in a 401k,
Yeah.
what I can tell you is if you don't want to take the couple of hours that it's going to take to build or to read the book 401 Chaos, because I tell you what, when I read the book 401 Chaos, and that's 401 and then in parentheses K like you would,
Yeah.
like 401k, and then AOS, so 401 Chaos. I wanted to take up a pitchfork.
Oh yeah, it'll upset you.
Or either that or a good AR. I mean, I don't want to say that on.
Yeah.
but you realize, oh my gosh, there's so much in our society, and in fact in our whole government system that they're not necessarily for us.
Yeah.
From health to finances, the systems they put in place, they're not really built for us.
Correct.
They're built for people that pay big money.
This whole thing was set up for the financial institutions,
Yes.
in the government to win.
Yes.
Those two.
Yes.
And they're in cahoots,
Yes.
and both of them win.
Yes.
And if you take out either one, it doesn't work.
No, right.
And they're not going to change it.
No, they're not. So the question is what are you going to do? Are you going to leave your better future? If you're leaving your better future to your 401k, what I can tell you is you're not going to get to the point ever in your 401k that you have the amount of resources that you want or need in order to have the retirement that you want or need.
Yes.
Unless you are in an extreme mode of living life so tight right now. In
Yeah.
other words, you're gonna, if you live the next 40 years on, I mean, granted, we all need to live on less than what we earn.
Yeah.
Okay, so that you can set aside the amount of money that you need. But when you look at how that system is stacked against us, that if you put money into a stock market that's not in a 401k, yes, you have to pay capital gains on it.
Yeah.
But that's better than paying income tax.
Which is what you have to do once you start pulling that 401k money.
Correct. And what they want to, what the incentive that they're trying to tell you is that, well, you're in your peak earning years now,
Yeah.
but you'll be earning so much less. Well, not if I really do well.
Yeah, if I
right?
do well, yeah.
And I'm
it's like-
taking it out,
So let me do not well.
Yeah.
That way I can save money in taxes.
Yeah, not
No.
a good plan.
Yeah.
However, so but when I look at real estate and the wealth building opportunities through real estate, and when you look at the system of like 1031 exchanges and the depreciation, all the things that are stacked in your favor, I'm like, man, those guys up in DC, they must own real estate.
They must own real estate.
And you start doing the research, and you go, "Oh yeah, they own a lot of real
Yeah, of
estate."
course.
Yeah, they. So then you realize, okay, I'm no longer going against them. I'm, don't. I
If you
can
can't
spend
beat
a-
them, join them.
Correct.
Right? And this is one of those situations.
Yeah, and what I realized is that I was trying to beat them when I was in the health insurance business. I mean, I had a health insurance plan. It was absolutely amazing. Arlo. Oh, is that right? The Arlo
New
Pro
cameras
3,
coming out, I guess.
new cameras. So yeah, the question is only the Go though. I wonder if the Arlo Pro 3 is a replacement for the Arlo Go, and because only the Go has the cellular connection, and it's in fact I need to go out to the property on the east side of town, but I'm going to wait until actually I can probably do that today. So soon as I get off, man, I got a busy day today.
Yeah.
I got to really.
You might want to wait till after the meeting tomorrow.
No, actually, I want to go during the meeting so that I can show what level
Got
of
it.
like,
Makes sense.
hey, these are the kind of things that I've invested my
Yeah.
time and energy
Got
in,
it. Makes perfect
making
sense.
sure. And what have you been doing? Did you
Yeah.
even know that these? And then show the video of the break in and all that
Yeah.
kind of stuff.
All
So
the stuff you
yeah.
handled.
Yeah,
Yeah.
absolutely. These are the things behind
1
the scenes
minute.
that I'm not taking out of the deal.
Yeah, absolutely.
Yeah, I mean, you've been just kind of ignoring it, and then because of that, it's worth less because you've been ignoring it and
Yeah.
delaying and blah blah blah. So anyhow,
Absolutely.
Yeah.
So we've got the webinar tomorrow night.
Yeah.
You'll be in a meeting with some lawyers tomorrow.
correct.
Around this time.
Yep.
So have fun with that.
I will not be in the.
So I'll be in studio tomorrow. So tune in for that. We're gonna have a great week here at Right Path. We're gonna have a great week buying and selling some properties.
Absolutely.
And, we've got some deals
30
working in
seconds.
the
It'll be
Asset
great for
Buyers
the-
Club.
yeah, the
I'm
Asset
so
Buyers-
excited
yeah,
about
right,
that.
yeah.
I get fired up when I see other people
Oh,
winning,
my
dude.
gosh,
It
you and me
just
both.
really fires me up.
Yes.
And we want to see you win too. We want to pour into you. That's what we do here every day.
20 seconds.
We want to be able to do that to help you reach your brighter future. If we can do anything to help you get there, if you have any questions, reach out to us at support@rightpathrealestate.com. Register for
10
the
seconds.
webinar on our website as well. We'll be back tomorrow.
You'll be back tomorrow.
I'll be back tomorrow.
Right.
We'll be back Wednesday.
Yeah.
Everybody have a great week. Get your Monday started off right. This sets the tone for the week. Thanks.
You've been listening to Right Path Real Estate Radio. Find Tom at rightpathrealestate.com. You can put the fear behind you and listen every day from 9 to 10 a.m. on Business 1110 KTEK.